when we actually get to the point of we're going through the loan process, because a pre-qual does not actually mean that I have that loan money.
Right.
It just means that you kind of looked at it and you're like, yeah, that'll be fine.
That is the mortgage loan originator's opinion of what you will qualify for based on the information you gave them. We haven't verified your employment yet. You know, we haven't verified your bank statement yet. Basically, we're just drawing the map. We've got the sketch.
Okay.
The next step is I start collecting that information. And we do that in steps.
Okay. So let's walk through kind of what that looks like, because I assume that you don't just print off a piece of paper, send it to title to be signed, and then walk away with whatever your payment for that is. Right.
So the way I look at it is the first step you want to do is a pre-qualification. It doesn't cost anything, and it should take the loan officer about 10 minutes to run through and do a quick pre-qualification, because they can see any red flags that may come up and address those right then. The next step is you find a property. Then the next step is you do the formal loan application, which begins the pre-approval process. Now, if you have a unique situation or a challenging loan, you might want to do the pre-approval all the way through first. But in most cases, if you're working with an experienced mortgage loan originator, they will know up front if you're going to qualify or not. And so I always start with those 3 steps: pre-qualify, find a house, and then we'll do the full-blown loan application. And then we walk you through that in steps. First thing that we're going to do is send you some disclosures. They're very easy. They don't commit you to anything. All they do is kind of tell you, what's my payment, this is how much money we're estimating you're going to need, and the terms that we're looking to qualify you. So I'm going to send you those disclosures, and I'm also going to send you a needs list. And it'll be, you know, income, asset, and any miscellaneous stuff that we might need. So we do that in steps. Once I have that, I submit it to underwriting. They approve it. The next step is I order an appraisal, or my processor. Go ahead.
What is underwriting?
Underwriting. I won't say what I was going to say.
I mean, now you might as well.
Underwriters are my favorite people, and they're the heroes. You want them on your side. Underwriters, they're the check and balance in our system.
Okay.
So I'm the upfront guy trying to make this. I'm looking out for the buyer. Their job is to make sure that they also look out for the buyer, but that we have a loan that can be sold on that secondary market. So, you know, I'm the advocate for the buyer. They're the advocate to make sure this loan gets sold. So if you have a good working relationship, you send them everything they need up front. They still might ask for some clarification, and that would, like I said, is what I do after I initially submit your loan application, after I get your needs list. And they'll send it to me, and if I dispute anything, which if it's easy to get, I try not to dispute, because you want them on your good side, because they can make or break your life. But you send them in a file, they'll send it back. If they need further documentation or an explanation, they'll let me know, and I will let the buyer know. And I'll explain what it is we're getting and why we're getting it and what would satisfy that condition. That's called an underwriting condition. But underwriters are the people that have the authority to actually final approve a loan and send it to closing.
Okay. Sorry, I didn't mean to interrupt you
No,
there.
that's okay.
So we go from underwriter to appraisal process.
Yep.
I think is where we left off.
Right. And sometimes I'll order the appraisal if I know this loan's going to go through. And after 30 years, I typically will know. We'll order the appraisal. But I try to make 2 things have been completed first. One, I know they're going to be approved, because I don't want to spend their money on an appraisal. I don't even collect it up front. And 2, I will work with the agent, like Haley, to make sure they're comfortable if the inspection hasn't been done yet. Because I don't want them to pay for an appraisal and then go out and find out there's inspection items that can't be resolved. So we coordinate all of that between the agent and the lender. And of course, keep the buyer informed as well.
Okay. That's a lot. That is a lot more than just writing a number down on a piece of paper.
Right.
And while we were talking about underwriters, you mentioned the secondary sale process.
Right.
Can you talk a little bit more, just briefly, because I don't
Right.
know that I really need to understand it,
Right.
but what is it? Why does it happen? How do I know when it's legitimate and not just a letter of somebody saying, hey, pay me your money now?
Right. Right. Okay, so just go from here?
Yeah.
So underwriting, like I said, they're looking out to make sure
No. Sorry, that was just I was actually asking the question there.
So yeah, they're just making sure that we can sell those loans. Remember, I told you rates are based on Wall Street, mortgage-backed securities. So those guys set the guidelines and regulations. It's the underwriter's job to make sure all the T's are crossed and all the I's are dotted. And they'll come to me if we've missed something up front. So those are called underwriting conditions. But we're all on the same team. It's just they're making sure it can be sold and delivered based on the terms that I tell the buyer we're going to do it. So that's how kind of the underwriting process works. So they're important, and they have to be, they're not licensed like us, but they have different certifications to be able to approve VA loans or FHA loans or conventional loans. They have to be approved with the actual investors.
Okay. So what is that loan selling process?
Right.
I don't know that we don't really need to get into the weeds of how that gets debated, but what is it and how do I know when I get my piece of paper that says, oh, pay all of your money to me now?
Right.
How do I know when that's legitimate?
That's a great question. Legally, you have to receive what's called an exit letter from your current lender. And then you have to receive a welcome letter from the new lender. And everything has to match. The way we do it is as soon as a loan is sold, and by the way, I just want to mention, that's how mortgage companies, when they sell the loans, it's the people on Wall Street that are getting that interest. It's not the bank. That's why you won't see big variances. We get paid to do what's called service a loan. That means we collect your payments, make sure your taxes are paid, make sure your insurance are paid, and Wall Street pays us to do that. And so if we're selling a loan on Wall Street, the interest goes then, the servicing goes to us. So the way you will know is because right now we sell all of our servicing. And that's just an investment strategy that's at the top end of the corporate, above my pay grade, on short-term and long-term investing. But in a nutshell, they will send a letter to me and to you that says, hey, we've sold the servicing to this lender effective on this day. Then I make a personal phone call to let them know it's legitimate. Because when you buy a house, after you close, that deed of trust is a public record. You're going to get junk mail. You're going to get, people that are saying you need to pay this to get a copy of your warranty deed. Right? So I tell my buyers, anything you get, run by me if you have any questions, because most of it is sales. And if we send you something, I will follow it up with an email personally from me and a phone call.
Okay. Thank you. So thank you so much for spending so much time with me. I know that I ran really long today. I appreciate it a lot. We'll put your contact info up here again. Before we close out, is there anything that I, the consumer, should do before sitting down with you to be prepared and make this process more successful?
Yeah, like I said, the two biggest things we look at is debt to income ratio and credit. So you want to get your credit score. 620, they say, is the minimum. Some say they'll go below that, but usually there's overlays. But 620 or higher. Remember, the higher your credit score, the better the rate and the terms. And the higher you can get qualified for, if that's what you want to do. I would tell you that for debt to income ratios, you generally want to keep it, the guideline, remember we talked about guidelines, is that your total debt shouldn't exceed your minimum payments. When I say that, I'm not talking about balances.
Okay.
I'm talking about minimum payments.
Okay.
Shouldn't exceed 43% of your gross income. That's the vanilla guideline. You can go way higher than that. You can go up to 50 on conventional and even higher on FHA and VA. So I would say you want to do that. If you want to improve your credit score, a couple of quick tips here. It's huge. Keep your revolving balances less than 30% of what's available.
What's a revolving balance?
So a revolving is anything you can charge up and pay down.
Okay.
Credit cards,
Okay.
lines of credit, anything that you can charge up and pay down. You want to keep it at 30% or less. So if I give you an example, if you have a card that has a $1,000 limit, you want to keep it at $300 or less all the time. If it's over, and I had one happen, that it was at 900 on 1,000. I had them pay it down $600 and it raised their credit score 80 points.
Wow.
Another quick thing, people that have limited credit, but they might have a family member that would put them on as an authorized user on that credit card, automatically will improve their score. Okay. So there's some tricks to working with credit scores for people that have limited credit, even for people that, you know, may have a credit score that's too low. There's ways for us to get that up. And we run what's called, I call it my what if simulator, and it's right through the credit report. Mm-hmm. So I'm not a credit counselor, but I can go in and plug in, okay, what if they paid this off? Mm-hmm. And it will simulate how many points their score will go up. Okay. So I don't tell people to do it without making a very educated guess. They won't guarantee it, but it will tell me, and usually it's accurate.
Okay, cool.
So there's a lot of things you can do there. There's a lot of things. I don't know, do you want to talk about student loans? Or is it?
Yeah.
So student loans, it's another myth. Everybody thinks if you have student loans, you can't buy. That's absolutely not true. The only thing is I have to count some kind of payment if it's deferred. If the payment's already on there, I just count it like a regular loan. But if the payment's not on there and it's deferred, there's a formula, and they're all different, but they've recently relaxed those, like by half, what I used to have to count versus what I have to count now. And I can run those numbers for you, so do not let student loans, and that's not just with me, because like I said, I wish I was that special, but I'm not. All lenders. This is FHA, VA, Fannie Mae, Freddie Mac, and I know those might not mean a lot to you, but those are the guys that make the guidelines and the regulations.
And it should be something that means something to you.
Right.
Which is why we go to the professional.
Right. And there's ways to get around, but don't let student loans and large down payments affect your decision making, because it still makes sense to buy a house if it's right for you at that time.
Awesome. Thank you. That's about where we're at today. Come back next time and we're going to get into the contract itself. So thanks, everybody.